Let's get back to oil. Oil recovering somewhat from its sell-off of the past week, but the market is cautious, of course, that we could be in a glut situation. Our guest says we've just seen a violent change in emotions here. Even a week ago, there were concerns that a widening conflict in the Mideast would cut off supply. But now there are fears of a glut. We're joined by Rebecca Babin, senior energy trader at CIBC Private Wealth. Thank you very much for joining us, Rebecca. Incredible change in sentiment so abruptly.
Yeah, we really have seen the pendulum swing really aggressively from the buildup into the end of last week, where we were talking about potential supply disruptions in the Strait of Hormuz, which obviously accounts for 20 million barrels of the 102 million barrels that we consume on a daily basis. So really worrying about lack of supply and what could happen, to coming in on Monday and having that entirely kind of wiped out, and now the pendulum swinging really aggressively back to the other side, where everyone's saying, okay, if there's no supply risk, are we actually looking at a supply glut in the second half of the year? And that's the transition, and the velocity of that move has really been pretty extreme. There just has been no middle ground between I'm worried about we're losing supply to I'm worried about being oversupplied. It's just kind of moving between those two poles really aggressively.
It seems like for decades we've been hearing, Iran might try to close the Strait of Hormuz, but that's going to be technically hard, and the Americans will have something to say about it.
It's never actually been fully closed. There have been disruptions to shipping through the strait, so you're right. And it's something that's been threatened frequently. But I think in this scenario, it felt like this was the closest we've been, maybe since the 1980s tanker wars, to seeing a disruption in the Strait of Hormuz. And it doesn't take much. It doesn't take a huge shift in probabilities to get a large price increase from that, because it represents such a large percentage of global supply that moves through there. So I think the market actually handled that situation in stride. In the past, without the buffers that we have with spare capacity or U.S. shale production, we could have easily seen crude in the 90s to 100 on the escalation we saw last week. I thought the response was pretty moderated. And the reversal, although extreme, really just reflects this idea that the underlying fundamentals are just looking a little bit softer in the second half of the year. So there's not this willingness to come in if your catalyst was a supply disruption and you don't get it, and you start unwinding those trades, you're not sticking around to say, well, maybe we hold 60. You're like, I want out. I don't really know where fundamentals support the commodity. And I think that was the kind of exaggerated move we saw on Monday and Tuesday. We have recovered off those lows, as obviously there's still a lot of unknowns here in terms of how things play out. And keep in mind, we still don't know how things play out in Russia, Ukraine either. So the market's still fluid, but I'd say the fundamental backdrop is a little bit more in focus. In the very short term, however, if you look at the inventory data that came out yesterday, the market's actually relatively tight and in a good spot right now. It's the second half of the year that has everyone really worried.
It's interesting. We've heard commentary to the effect that the market has just priced out a risk premium, a Mideast supply risk premium in oil. And you think if it has, it's premature, that we're not out of the woods yet?
So I think we've priced out about 85 to 90% of the risk premium in the commodity over the course of the 2 days. I mean, if you look at a chart, we're essentially right back to where we were before, the 12-day war started on the 13th, June 13th. I wouldn't say it's a zero number, but it's obviously very small. I do tend to think that might be premature, only because there's a lot of variables between kind of where we are now and getting a nuclear deal per se, or what happens next. And then I'm also looking at Russia, Ukraine. Like, we haven't made progress there. There are calls for additional sanctions coming out of Europe. I think there's some risk there. So I don't want to take that premium to zero, but I understand that this isn't just about taking the premium out. It's about the positioning reset, right? There was a lot lot of long buildup as the kind of escalation kind of unfolded over the last 2 weeks, not just in the commodity itself, but in the options underlying the commodity. Tremendous amount of options volume and upside calls. As those just get unwound, there's going to be this kind of overshoot, and I can see it's just taking some time to recalibrate and reevaluate the risks that lay before us.
You touched on this already, Rebecca, but you say that it's easy to see a surplus building in the second half of the year in oil?
Absolutely. So in the second half of the year, we have a couple of factors. We have demand that's going to we're in a very seasonally strong time for demand right now in the summer. Demand is going to start to fade. We may have the kicking in of tariffs that are set to be imposed. And then we also have a lot of supply coming from OPEC Plus, right? They've started unwinding their production cuts and they've been layering those on, and they're set to have brought back the full 2.2 million barrels of their production cuts by October if they keep up the pace they're at. That's a lot of additional supply. Non-OPEC supply is also expected to grow in the face of a slowing demand profile just seasonally, and as we kind of think about how tariffs impact demand. So those two combination of things are what's driving that build in the second half of the year. I actually think, given how well telegraphed this is, almost every analyst is talking about this, and the fact that maybe the OPEC kind of unwinds, when we look at the countries that are actually already producing at capacity, do we actually get the full 2.4 back that's on paper, or do we get something less because some of those producers are already tapped out? I think there's a chance that the market surprises us with a little bit better demand, not such strong supply, and it's not quite as dire as the kind of analyst community might be thinking it'll be in the second half.